All right, today we're going to put on our Warren Buffett hats and dig into a really fascinating company. See, it provides insurance for our pets, but here's the kicker. For most of its life, it hasn't actually reported a profit. So how on earth could it possibly be a hidden gem? Well, we're going to follow the clues, just like Buffett would, and find out. Now, I know what you're thinking. This question goes against pretty much everything we're taught about investing. Losses are bad, profits are good. End of story, right? But what if it's not that simple? We're going to follow the evidence piece by piece and see if the numbers tell a very different story. Okay, so let's pull back the curtain on the company we're investigating. It's called Trupanion. They're in the pet medical insurance business, and on the surface, they look like the kind of company a traditional value investor like Buffett would toss in the no pile immediately. But let's look a little closer. The business itself is beautifully simple, which is something Buffett loves. You pay a monthly fee, and Trupanion covers those unexpected and often huge vet bills. But their secret sauce is how they do it. They pay the vet directly, right there in the office, in seconds. No painful paperwork, no waiting weeks for a check in the mail. It's a simple, high-value toll bridge that connects pet owners and their vets just seamlessly. And here's where we hit our first major puzzle. Trupanion absolutely fails the classic Buffett test, right? No long history of profit. But, and this is so important, it looks exactly like Geico did when Buffett first invested. He saw that while the reported profits were low, the economics of winning each new customer were just brilliant. Trupanion fits that exact same profile. It's a bit of a throwback. So, if the business model itself checks out, does it have any protection? You know, a secret weapon. In Buffett's world, this is what he calls an economic moat. And for him, it is absolutely non-negotiable for any long-term investment. So what is a moat? Well, think of a real moat around a castle. It's anything that keeps competitors from storming the gates and stealing your profits. It's what separates a good business from a truly great, durable one. The real question is, does Trupanion have one? As it turns out, it doesn't just have one moat. It's got like a 3-layer defense system. First, there's its proprietary software that pays vets instantly. That's incredibly hard for a competitor to replicate. Second, once a pet has a pre-existing condition, switching to a new insurer is basically impossible. That locks customers in, creating really high loyalty. And third, with data on over 1.6 million pets, they can price their policies way more accurately than any newcomer could. You know, a great business with a great moat can still be ruined by bad management. So for our next step, we have to put the leadership team under the microscope. Are they making smart, rational decisions with the company's money? And the evidence here is pretty compelling. Instead of paying out dividends, they take every single dollar the business generates and plow it right back into acquiring more pets, and they earn a fantastic 30% return on that money. They're fueling all this growth while also paying down debt to make the business safer. I mean, that is just textbook rational leadership. And just as important, they're honest. When vet costs were spiking, they told shareholders about it directly. They don't use those confusing, adjusted numbers to try and hide bad news. This kind of straight talk is incredibly rare, and it is very, very Buffett-esque. Okay, now for what might be the most important part of this whole investigation, the financials. This is where we uncover how a company that looks unprofitable on the surface might actually be a hidden cash-generating machine. The key here, the thing you have to get, is the difference between two numbers. On the left, you've got the official net income. That's what the accounting rules say the profit is. On the right, you have what Buffett calls owner earnings, or what we often call free cash flow. Just think of that as the actual cash left in the company's wallet at the end of the year. For this particular business, these two numbers tell two wildly different stories. So if you look at the projections for 2025, Trupanion's official reported net income is only about $19.4 million. Okay, it's a profit, sure, but it's not a huge number. This is the figure that most people see, and it's probably why they might just dismiss the stock and move on. But look at this. The actual cash the business is projected to generate in that same year is over $75 million. That is nearly 4 times the reported profit. So where in the world is all this extra cash coming from? How is that even possible? It all comes down to a quirk in accounting. When Trupanion spends money on marketing to sign up a new puppy, accounting rules say they have to book that entire cost immediately in that quarter. This crushes reported profits and makes them look small. But that one puppy is going to stay with them for 6 or 7 years, generating a predictable stream of cash payments every single month. What you get is a growing river of cash that's hidden by the dam of accounting rules. So now that we understand the real cash earnings of the business, we can do what Buffett does best. We can figure out what the whole business is actually worth and then see if it's selling for a good price. Based on all those future cash flows, this analysis estimates Trupanion's intrinsic value, what it's really worth, is somewhere between $42 and $46 a share. But as of the time of this analysis, its market price, what you can actually buy it for, is only around $32. That gap between the value and the price gives us a margin of safety of about 29%. This is a core Buffett principle, right? It's like buying a $1 item for 71 cents. It just gives you this wonderful cushion in case your estimates are a little bit off. Okay, we followed the evidence through the business, the moat, the management, and the money. Now it's time to bring it all together and land the plane with a final verdict. So let's just lay it all out. On the one hand, the bull case. You've got a durable moat, fantastic management, really strong cash flow growth, and it's all selling at a discount. On the other hand, the bear case. There's that lack of a long profit history, a currently low return on equity, and the real risk that regulators could slow them down. So it's a balanced picture for sure. So the final verdict from this analysis is this. It passes with caution. The big takeaway is that it seems to have all the qualities of a great Buffett-style business, but it's hidden inside an accounting structure that makes it look like a typical unprofitable growth company. You just have to be willing to look a little deeper to see the real story. And that really leaves us with a fascinating question to chew on. If Trupanion's true value is hidden in plain sight by the way we do accounting, what other great businesses are out there right now, completely misunderstood by the market, just waiting for someone to discover them?